What's up, everybody? Welcome back to the channel. It's your favorite realtor, Josh Anton, with the Greathouse Team and RE/MAX Above and Beyond here in Cleveland, Ohio. It's a great day. You know why? Because I've got the Dean of Mortgages, Jon Washburn from Steadfast Mortgage, here with me today. What's up, Jon?
What is up, man? Great to be here. Great to hang out with the Greathouse Team as always. And very excited to talk about something that you and I love to do, that is real estate investing. So today we're going to answer the 5 biggest questions that we often get from people that are trying to invest in Northeast Ohio.
Let's go. All right, so very grateful to have Jon here with me to share his advice on the lending side. So Jon, the number one overarching question, I'm sure you probably get it too, is around rates. So I want you to tell the audience the rate question as it pertains to investments.
Absolutely. So people that are investing, they're really worried about the cash flow. So rate is the most important, the first question they always ask me. Now, as a lender, if I'm going to quote a rate to you, there's a laundry list of disclosures that I have to recite off. So I'm not going to give anyone a specific rate, but generally, interest rates for investment properties are about a point to a point and a half higher than what they are in regular primary purchases. So if today's regular rate for a well-qualified buyer buying a primary house is about 6.5, you could be looking at something in the 7.5 range for an investment property. Most of the time as well, that 7.5 is probably going to come with a discount point or two. Every lender is very different, right? You know, I as a mortgage broker, I'm actually able to shop around to more than 110 different lenders right now. And some lenders love investment properties. Some lenders hate investment properties. It's kind of like airlines. Everyone will do it, but everyone's going to offer a little bit different thing, a little bit different experience. So you definitely want to see which lender, which option is best for you when you're going to purchase an investment property. Another thing that's going to greatly affect interest rates on investment properties is your down payment. You only have to put 15% down to buy a single family investment property, but you are going to get the best interest rate at 25%. And it's a lot different than, you know, those same options on a primary. On a primary residence, putting a little more money down is going to help your rate a little bit. The investment side of things, it's going to help quite a lot.
So you brought up a couple of good points there. Number one, who you're talking to on the lending side is very, very important. Similar to who you talk to as your realtor, right? Make sure you're talking to an investor-friendly lender that has access to a variety of products. And we like to refer folks to people that are more consultative, can listen and hear out your scenario, take your financials, and has access to a variety of programs that can really fit your needs and give you some options to really go by. So that's great that you have access to that, and very important.
Yeah. No, absolutely. The investment world, I always tell investors, people that have bought homes before but have never invested, we're using the same vocabulary, but it's a little bit different dictionary. So everything's going to be a little bit different. So yeah, you want to work with a real estate agent that has worked with investors before, knows what he's doing, knows some of the, you know, the different things to look out for on, you know, point of sale and different things that might happen at different little areas all around Northeast Ohio, right? Same thing on the lender side. Every lender has a different specialty. Every lender has sort of different options for people. So we want to make sure that we figure out your situation and match you with the best lender for your situation.
Outstanding. So moving forward, as you're calculating your returns and doing all of your research on these properties, take into account that you're likely looking at a point and a half on top of your standard going rate for an investment property. Make sure that you're analyzing and getting correct data. Very important when you're analyzing a deal. Okay, so the next question we get hammered with is, what type of loan should I do? Should I do a standard conventional in my personal name? Am I able to do that? Should I put one in an LLC with a portfolio loan? Does that make more sense? So Jon, just share with the audience maybe the types of buckets or your strategy pertaining to the types of loan you should do as an investor.
Absolutely, yeah. So when people ask me what's the best type of loan, I say there's not a best type because certain loans are better for different people. It's really what do you value most, okay? If you've never invested in property before and you're trying to get into it, you're probably going to care most about cost, rate, your bottom line, right? So if you care most about cost and rate in your bottom line, you're going to want to get a conventional loan. Conventional loans are great. They come with the best pricing, but they also come with the most restrictions. They come with the most rules, and they by far require the most paperwork. We're going to need W-2s, pay stubs, bank statements, tax returns, CPA letters, mortgage statements, and probably your third-born's blood type, right? Yeah. That type of thing. We're probably not going to close most investment deals with conventional loans in 20, 25 days, right? We're going to need a little bit longer closing period for them. You're going to end that process with the best rate, save the most money long term, but it's going to be one of those deals where I'm sure you've had closings like this. Sometimes you get to closing and you're popping champagne and everything's great. And other times you feel like somebody has dragged you across the finish line the last 2 weeks. That's how oftentimes investment property conventional loans can go, right? For investors that have compiled or have already bought several properties, they're often looking at something else. They're valuing time, they're valuing ease. So we have another bucket of loans that aren't conventional loans, and they are really set up for investors. We may not need tax returns. We may not need pay stubs. We're not going to need mortgage statements for all of your properties, homeowners insurance binders for all your properties. We might just look at the property that you're buying and a bank statement, and we don't even really look at your bank statement that hard. You could have, gotten a loan from somebody else for the down payment, because these loans are specifically set up for investors that are trying to get 2, 3, 4, 5 properties this year. That bucket is going to leave you with a little bit higher interest rate, but much less aggravation. If we need to close in 3, 4 weeks, we can do it, that sort of thing. So you're really kind of, my buddy likes to say, there's 3 things in life that you can buy, right? You can buy cost, you can buy speed, and you can buy ease. When you're in the investment property world, it's usually not possible to get all 3, right? You might be able to get 2, but you're not going to be able to get the cheapest loan possible that's also super easy, that requires no documentation, that we can also close in 3 weeks. Yeah. That sort of thing doesn't exist. So as you're thinking about what type of investor you are, you're going to be more inclined to choose one bucket or the other.
Those are fantastic points. And I think one thing that's important to sort of piggyback off of that is, how does the program or the loan you're going to do impact the real estate purchase in of itself? And what I mean by that is, if you're the type of person and your goals are the cheapest, you want to get the best rate possible, but it might take longer because you got to give your firstborn and you got to give the taxes and all of that. And I went through that buying mine in an LLC with a portfolio loan. I had my accountant rushing to get my taxes done that year. I had operating agreements and LLC and leases. It was crazy the amount of stuff I was doing. It took a lot longer. And for me as a realtor now representing buyers, when that timeline's drawn out, sometimes that offer maybe doesn't look as advantageous to the seller if we're drawing it out 60 days. So understand how each decision you make on the loan can sort of impact that purchase. Now, of course, just because you're 60 days out and you want to be thorough and you want the cheapest doesn't mean you can't buy property here. Just keep your expectations reasonable when you're doing that. And that's where like teaming up and everybody on the same page is really going to help sort of get through those details.
Absolutely. And, my point in giving the pros and cons of each one is not to try to encourage people that one is better than the other. Yeah. Again, we just want to set proper expectations. I work with a lot of people that, when they go on a flight, the only thing they care about is cost. They don't care that their seat reclines on their ride. They don't care that there's in-flight movies that they want to watch. All they care about is cost, and that's fine. That's great. If all you care about is costs, we're going to go the conventional route. We're going to get you the best possible rate on an investment property. I just want you to know up front, it's not going to be a 20-day close. You're going to be mad at me at some point. You're going to call Josh up and be like, "What? Why is this guy asking me for this? We told you up front, this is what it's going to be. We want you to know exactly what you're in for when you get into the investment world."
Fantastic. All right, this is a big one for me. It's hitting home because we're getting an abundance of calls and inquiries around a certain type of loan program that is gaining heavy traction, and it's the DSCR loan. Now, this is a newer concept to me. Admittedly, I just became attuned to it maybe 6 months ago. So, John, really dumb it down for our audience here who may not even know what the heck we're talking about.
Right.
What is a DSCR loan and how can you benefit from it?
Absolutely. Yeah. Probably 1 out of every 2 investors that I talk to wants to know about the DSCR. So first of all, DSCR stands for Debt Service Coverage Ratio. Here's essentially how it works. We don't care how much money you made last year. We don't care how many liabilities you have in real life. We're going to look at your credit. It's got to be passable, 660 or higher usually.
Okay.
We need you to have money for a down payment, 15% minimum, sometimes 20 to 25%.
Okay.
But then really the only thing we care about is, will this property that you're trying to buy make money? So let's say the mortgage on this property is going to be $1,000 a month.
Okay.
If you can rent that property out for $1,001 a month, we can do the loan.
Awesome.
So if that property is going to make more money than you have to spend on your mortgage, and you've got money for a down payment, decent credit, you've got a little money left over in the bank for reserves afterwards, we can qualify you for the loan. It doesn't matter how many other debts you have. It doesn't matter. You could be making $0. We don't even ask for pay stubs. We don't even ask to see if you have a job for the DSCR loan. All we care about is this property going to cash flow? Now, we can go all the way down to 1%. So that'd be your mortgage is $1,000 and then you're renting it for $1,001. Get a little bit better rate if you're at a 1.15% DSCR ratio. So if you can get at least $1,150 on that $1,000 mortgage, that's better. If you can get at least $1,300, a 1.3%, you get the best rate in terms on the DSCR. And if you find something like that, the rates on DSCR at 1.3 or higher are honestly not much worse than rates on conventional loans. You're probably going to be at the same rate, paying one more discount point or so, but that's what we do. We don't care about bank statements. Well, we do care about bank statements. We don't take away tax returns, income docs, liabilities, anything like that. Does that property make money? How do we figure out if it makes money? Two ways.
You got it before I was going to get it. All right.
Yeah.
The realtor in me is like, okay, where are we going to get this data from if it's not rented?
For sure. So if it's rented, we can use that lease agreement. If it's not rented, we just get a special appraisal, right? It's called a 1007 rent schedule appraisal. Okay. So it's a regular appraisal that's going to give us the value of the property just like any other appraisal. But then there's going to be a separate schedule attached to that appraisal where the appraiser is going to do some research and he's going to say, this property should be rented for X amount per month in this area. And as long as that number on the rent schedule is higher than what your mortgage payment is going to be, we can qualify you for the loan. These are good options for single families. These are incredible options for multifamilies. Because as you know, multifamily units all the way up to 4, 5, 6, 8, those are the ones that are going to cash flow like crazy.
So the realtor in me loves the transparency of it from like, it's so easy, right? And I'm thinking, okay, competitive market, we can say, hey, this is a DCR where we're really doing minimal on the front end from a qualification standpoint, how to make sure it's cash flowing. When we're writing these purchase agreements, like, how do we write it? Do we write DSCR in there where it says conventional? Like,
sure.
I'm more curious how that might work. And then I'm going to ask you one more. How many DSCRs can I do?
Yeah, 2 great questions. So normally you're going to see on purchase agreements, conventional, FHA, VA, other. This will go down as other.
Okay.
And I like to tell them DSCR. This is, because there's many types of, in that other field is a whole world called non-QM. And sometimes non-QM means like I had a bankruptcy last week and I couldn't get any other loan, but I got money in the bank, so I'm going non-QM, right? That can sometimes potentially bother, listing agents, right? But if it's DSCR, this is a well-qualified investor that's done this before. That's not quite going to make your offer a cash deal, but it's just as good as conventional. It's a very good offer. The other question you asked,
how many can I do?
How many can I do? Great question. So if you're doing conventional loans, you're capped out at 10. You are capped out at 10 with Fannie and Freddie. You can't get more than 10 conventional loans. DSCR, this is lender to lender, but I have one lender that will let you do 28 DSCR loans with them. And then we could go to another lender and do another 20. And we could go to another lender and do another 20, right? So really there is no max. That's another beautiful thing about the DSCR. Low doc, very easy process. We're looking at an appraisal. We want to make sure that there is a positive cash flow, but as long as that it is, that's all we got. And you could do 10, 15, 20 of them this year, no caps on it, do as many as you can. The sky's the limit.
So I don't want to go too much into this topic here, but it almost seems too good to be true. Like if I'm looking at it from the consumer lens, saying, boy, this thing's just like too good to be. Are there any downsides to it?
Yeah, so I did about 15 of these last year, and one of them didn't work, right? One of them didn't work, and that was one where the appraiser said, hey, we only think that you could get this much rent on it.
Okay.
And there wasn't a renter already in there. And at that point, it's kind of like any other deal. Appraisals can sometimes kill the deal. Mm-hmm. So there is a way that the DSCR can die. Realtor and the buyer were expecting they were going to be able to get $1,500-$1,600 a month from it. The appraiser, I don't know if they weren't as well attuned to the area as they should have been, but they said it was only a $1,200 a month rental. Didn't have a good enough DSCR ratio. We weren't able to complete it as a DSCR loan, but for that guy, we were able to switch programs and still get it done. But that would be the downside. You want to make sure that you're doing a lot of research up front with your real estate agent so that okay, how much can we realistically rent this for, as opposed to, I think it's going to bring in X amount a month.
Yeah. And we have a lot of tools, as many of you know, through different venues that we subscribe to, the rentometers and bigger pockets of the world that can give us some really good data as to what that, typical rental can go for. So we try to get it nailed down as best we can. We'll all collaborate and make sure to make the right decision. But for those of you out there that are unfamiliar or haven't really dug into it, D.S.C.R, I think this is the future of investing. And I'm really, really looking forward to diving into those more.
Absolutely.
All right, so the next question that we get quite a bit is, okay, we want to build a portfolio, want to start investing, we're going to buy some houses in Cleveland. We want to then leverage those properties, refinance or whatever, and have them help fund our continued portfolio building, right? So talk a little bit about that approach and long-term thinking as it pertains to investing.
Yeah, so the most important thing on this front is you got to make sure you're getting a house at a good value, right? And this is where you need to work with real estate agents that are very up to date and very keen on the investment market. So if you can get a house at a great value, hold on to that for a little bit, maybe do some minor repairs, maybe fix it up a little bit. A year from now, you could have a lot of equity in there that you would be able to cash out and in turn put that on another property. As a lender, I do have some options that can help investors with this. I have a fix and flip loan, which is a really great option for anyone that sees a great potential, a house with great future potential that needs some work right now, right? So we can get you into this for low money down, finance all of the renovations. It's, like a 12, 18 month interest only loan. You're not going to be in it very long. You're just trying to renovate the house. And then 3, 6, 9 months from now, after everything is renovated, you've now, maybe you put 50 grand into a house, but you've increased the value by 100 grand. You can get all that money back and then some. So that's a great way to, sort of leverage the ability to find a house that is a devalued house that you put some work into it, you're going to get that money back.
Okay.
Another option is a lot of times investors, we talked earlier, you can only have 10 conventional loans. Mm-hmm. A lot of times investors get to this point and then they're kind of stuck. So we've got some other options, like we've got a blanket loan. We can take 10 of your properties that you have, put them all into one loan with one monthly payment. That's pretty competitive. And now you can start back at one, get 10 more conventional loans, the cheapest loans you can possibly get, and just keep building your portfolio that way, and also radically simplify your life. Instead of making 10 mortgage payments every month, you're just making one, and we got it all for you. So, those are some different things. Again, it's all about options. what is out there that we can use to, leverage everything we have. But the most important thing is you got to find a house at a good value. And that's kind of where you and David are coming into play. I'm not telling you what the value of the house is. I'm just giving you the money. These are the ones that are going to be telling you, here's the house that's for you.
That's a kind way to say do your damn job, right?
Right.
Yeah, no, absolutely. Always look for good value. And I think the one advice I can give there is spending some time identifying your resources there. Because what we're talking about is finding something at value and putting a little more sweat into it, right? Renovations and whatnot. So having the pieces in place, we did a video about build your team. Make sure you've got that confidence. So when you find that home and that value, you're not losing money by that drawing out. So make sure you got your team in place to get that done. But if you do, this guy here's got a lot of different options for you. That's outstanding.
That's right.
All right, John. So I'm going to tee up a scenario for you. This is a very, very typical conversation when someone from YouTube reaches out and they call and they say, hey, Josh, I'm looking to invest in Cleveland. I say, great. What are you looking to do? And more often than not, it's I want to buy multi-unit properties and I want them to be four units. And the first question I ask is, why four? What's going on?
Yeah, great question. So the greatest cash flow possible is going to come on multi-unit properties. And 4 is the max that you can get on a residential loan. So if you're trying to get a residential conventional loan for an investment property, you can go up to 4 units. Mm-hmm. And I'm a broker. I work with over 110 different lenders. All 110 different lenders can go up to 4 on an investment property.
Okay.
A lot of people don't realize you can actually go higher though. You can go 6, you can go 8. I've got an investor that will go up to 20, right? I'm working with somebody right now who's buying a 16-unit apartment building, all right? Why wouldn't we do that? Why wouldn't they ask you about that? The reason is they don't know it exists, right? So I've got 110 lenders that'll do the 1 to 4. I've got about 12 that'll do over 4,
there you go.
Right? So you might say, oh, I can go higher. It's all good, right? Well, things get a little bit trickier, all right? We want to be fair. There's only 12 lenders that I work with that'll do these purchases of more than 4 units. So because there's only 12 instead of 110, they can be a little bit pickier. They can have, different terms, different requirements, different requests. But man, you get somebody, you find a good property. Like I said, I'm doing a 16-unit apartment building right now. I'm doing another one. It's a 7-unit where it's 5 apartments and 2 commercial properties on the bottom. Right?
Mixed use property.
7-unit mixed use D.S.C.R. We're getting over $4,000 a month from renters on this, and the mortgage is going to be less than $2,000. This is a place where you can get incredible value from a monthly cash flow perspective. So I just want to let everyone know that there's an option for you out there. You can go more than 4. You don't have to stop at 4. 4 is the sweet spot on residential, but sometimes you can get even more units. And you can get something that's even more positive for you from a cash flow standpoint.
Okay, so I'm going to put you on the spot real quick. Generally speaking, I know there are nuances, but when you look at a commercial type product or this, 5+ units, let's exclude mixed use because maybe that's a little different. So just a standard residential 6-unit, 8-unit, whatever. I mean, what can the typical consumer expect rate-wise or cost-wise relative to what a 1 to 4 might look like? Just paint a picture for me.
So the rate is not much different.
Okay.
The 2 things that are pretty different are down payment and credit requirement. Okay. Right. Regular DSCR for an investor on a single unit or a duplex, I only need you to be at about a 660. You could put as little as 15% down, maybe 20, right? Once we get over 5, 5 or more, I need you to be at a 700. So it's not something absurd. You don't have to have a perfect 830 credit score, but you can't be in the 6s anymore. Additionally, usually they're going to want to start out at 25% down, maybe even ask you to put 30% down. So a little bit more down payment, a little bit better credit. Okay. But at the end of the day, the rates and terms are not much different than they would be on any other investment property. And like we said, that is where you can really get into an awesome position from a monthly cash flow standpoint. That's
outstanding. So for those of you out there that are really pigeonholed or thinking, 1 to 4 because it may be easier or it may cost a lot less rate wise. What I'm taking from this is you might want to explore the alternative. I know that's kind of diving right in for you first time investors saying, oh, I'm going to go buy an 8-unit property. That might not be the most responsible thing to do, but there are a lot of smart people out there that I think you should at least explore these alternatives,
Absolutely.
explore these with your lender and say, hey, look, this is viable if you find the right one. Certainly not out of the realm of possibility to get in and knock out 6, 8, 10 right off the rip. Why not?
There you go. If you want to own 6 investment properties, you could get it in one purchase if you get a 6-unit.
Oh, that's awesome.
Yeah.
Very good. All right, so there you have it. You have been schooled by the Dean of Mortgages on, the top questions that we get relative to investing and what the lending process looks like. You got anything else to add, John?
Yeah, no, appreciate you bringing me over, letting me talk to investors. I love working with investors. More than 25% of my personal business last year with home buyers was with investors. So it's something I'm passionate about because a lot of people out here are doing it poorly, right? So we want to make sure that we are giving investors, the best possible service that we can. Follow me on Facebook, YouTube, Twitter, youtube.com/c/the Dean of Mortgages. Appreciate you letting me get on the show today.
Yeah, absolutely, man. Thank you. We're going to have all of his information below as well as ours. You know what to do. Subscribe to the channel. And of course, call us when you're ready to buy or sell